welcoming to here my colleague Julian Adams. I guess everyone knows this is the next of the PEFM seminars, which we normally hold on Mondays, except when we've sort of traded off other days of the week. So we're very happy here to have Julian here to talk about big picture insurance issues. We overlapped at the Bank of England in the last millennium, I think, for 6 years.
Yep.
So that was, and then we sort of diverged. And one of the interesting things is how one diverges and comes back again, as with several other people. I mean, with Chris, we also overlapped. And the things, as you probably know, I mean, Julian is now the Group Regulatory Director of the PRU since January 2015. And before that was Director of Insurance Supervision at the Bank of England, and moved between the Bank of England and the FSA as that went sort of in and out. So had the similar sort of role as Head of Insurance Supervision at the FSA. Was also the UK's board member on the European Insurance and Occupational Pensions Authority, IOPA, in Frankfurt. Sat on its management board, which itself is, I think, quite interesting. And its mediation panel, and he sits on the Strategy and Advisory Board of the Cass Business School, and he's on the board of the Association of British Insurers. And he played a key role in all sorts of innovations of insurance regulation, really, over the last 15 years. So the International Association of Insurance Supervisors and the GSII process, to just get into the acronyms which nobody will know about. But it's like the GSIB process, but for insurance companies, which will illuminate maybe one person in the room. It's deciding which insurance companies are so critically important you can't let them fail, which is the way in which the international community, one of the main ways the international community has addressed financial stability since the global financial crisis. So Julian's played a major part in protecting the world from insurance failures. And I pass it on over to you.
All right, well, I can't go wrong with a sort of an intro like that. Look, because this is going to be filmed, I'll be talking from text. I hope in the Q&A it can be a lot more discursive and free form. Just in terms of managing expectations, though, I'm not going to be talking about European Brexit type matters until, I guess, the Q&A, notwithstanding my European background. I'm very happy to talk about how the international authorities have structured insurance supervision in the context of whether they're globally, systemically important, or whether indeed, and if so, in what way, insurance companies are systemically important. But again, I prefer to leave that for the Q&A, although I do think actually it's quite an interesting debate, because I think to the extent that they may be different. They are certainly different from the way in which banks present themselves as a source of systemic risk. So look, it's a pleasure to be here. It's nice. Charles and I bumped into each other after a very long time when I was talking on a platform at Chatham House, and it's really nice to be here. I want to make it clear, given both my background and the industry I work in, status disclosure is an important regulatory feature. So the remarks I'm going to be making today are very much in a personal capacity. Obviously, they draw on almost 3 decades at the bank and the Financial Services Authority, but also, of course, they are going to be informed by my current role at the Prudential, where I sit on the group's executive committee with responsibility for government relations and for regulatory relations across the world. So, even though the remarks I'm going to have, they're obviously drawn on my experience, my views are not necessarily those of any organisation I've been involved with. Now, one of the nice things about coming up to Oxford is it's nice and leafy. It's not particularly urban. It's not, and I think even the most sort of occasional user of the London Underground network will sort of readily testify to the injunction of minding the gap is one that I think is tirelessly repeated at all stages of the journey. It's not entirely clear whether you repeat it because people ignore the warning, and so they constantly need reminding of the ever-present danger, or whether the risk of the gap is in fact mitigated by by its repetition. But what I wanted to do today was to talk to you about gaps of a different kind, Gaps which I'm afraid to say are stubbornly persistent, gaps which demand urgent and material action from policymakers, but which I think have largely been unaddressed or substantively unaddressed. And I want to explore some of the underlying causal trends for some of those gaps and then highlight opportunities for addressing them, and obviously be focusing on the role which the insurance sector as a whole can play in doing that. Now, the gaps I want to focus on then are first what we in the insurance world call the protection gap in life and health insurance, a gap that's growing in absolute terms as the global middle class grows. Secondly, the retirement gap, that's the gap between the income people need or expect they'll need in retirement, and the money that they or their governments are likely to be able to provide. And that is a gap that's growing in per capita terms as people live longer, and in aggregate terms as society's demographic profiles evolve. And thirdly and finally, the infrastructure gap between the new or improved infrastructure that's needed over the coming decades and current trends of spending on infrastructure that's a different kind of gap. But actually what I want to demonstrate is that it is in fact profoundly and inextricably linked to actually how we resolve and address the prior gaps. And I want to examine briefly the cause of each of these gaps, and then to demonstrate that interrelationship, the interdependency between, going on to explore how policy choices that are made to address each one individually can actually affect the probability of success in achieving them in aggregate. Now, I said I wasn't going to talk about Europe, but an area I am going to talk a lot about is Asia. And it's Asia, I'm going to talk about that bluntly for two reasons. First is it's an area where those trends and the gaps that I've highlighted are particularly significant, but it's also a very significant part of the Prudential's operations. We're obviously a very old UK company, but actually 80% of our earnings come from overseas, 40% from Asia, 40% from the US, 20% from the UK. Over half, or just around half of our 26 million customers worldwide live in Asia. So Asia is a big part of our business, and it's where a lot of the trends that I've highlighted earlier come to a head, I think. So, of course, one of the principal drivers, as this audience will know, of each of the gaps that I've highlighted is, of course, the enormous expansion of global population since the Second World War. And the scale of that has been nothing short of breathtaking. Between 1960 and 2017, the world's population went from 3 billion to 7.5 billion. At a country level, to take the two most obvious examples, China's population in 1960 was 667 million. In 2017, it was just under 1.4 billion. Over the same period, India grew from approximately 450 million people to now just over 1.3 billion. But it's not just the juggernauts. We're present, I said Asia is an important part of our business, we're present in 8 of the 10 ASEAN economies, meaning that's everywhere bar Myanmar and Brunei. Taken together, those 8 countries in under 60 years have gone from 192 million people to over 3 times that amount today. Now, of course, there's a well-established relationship between population growth and economic growth, and whilst the precise form of that relationship may be complex and differ between geographies, at a fundamental level, the relationship is at least intuitive. As economies grow, they have, historically at least, needed population growth to increase the supply of both workers and consumers. To look at those the earlier figures on overall population growth in another way, approximately 2 million workers will be added to the working age population across Asia every month for the next 2 decades. And the knock-on economic impact of this boom generation is there to be seen in the numbers. Globally, we've gone from a total GDP of $1.4 trillion to one of $80 trillion. China, the numbers are absolutely staggering. They've gone from a GDP of $60 billion in 1960 to 12 trillion in 2017. And that trend is observed elsewhere across the region. Now, a lot of people have talked about this heralding the Asia century and a pivot to the East. I'm not going to go over that ground. Those are developments that have been well covered by others. What I want to highlight, though, is that there are 4 particularly significant dimensions or effects of the population and economic growth that we've observed across Asia. The first is to note that the expansion in the working population has led to the emergence of a strong and relatively wealthy middle class across the region, the middle class. Depending upon the source you consult, Asia's middle class numbers between 500 million to 2 billion. They're set to grow to account for around 2/3 of the global middle class by 2030, according to the OECD. Private financial wealth across Asia estimated at 53 trillion in 2016 and is projected to grow by 4 trillion each year over the next 5 years to 78 trillion in 2021. But what's instructive about that wealth is the form it takes. Around 65% of it is held in cash. I'll come back a little later to look at that in more detail and also to have a look at the potential consequences for the financial stability of the region of that. The second factor is that as wealth has increased, so fertility rates have fallen. Quite simply, as people have got wealthier, they've had less babies. Demographers use the term replacement rate to express the amount of fertility needed to keep a population constant, taking into account various assumed mortality factors. And in developed countries, that's normally presented as 2.1 children per woman, but it can be higher for developing countries. Now, there's often a lot of focus on China's one-child policy, but in fact, replacement rates have fallen rapidly across Asia and broadly in line with increases in GDP. Apart from the Philippines, the replacement rate in every country in ASEAN is now under 3. In Singapore, Thailand, Vietnam, it's already dropped below 2.1. That's the replacement rate for a developed country. And Malaysia will soon follow. The third trend is that over the same period, individual life expectancy has been increasing across the board. Again, that's intuitive, given the higher levels of wealth generally being correlated with better diet, better living conditions, and better primary care. In 1966, it was common for life expectancy at birth to be under 50. That was the case in China, Laos, Cambodia, where it was only 42, and India, where it was only 45. 50 years later, it's over 65 in each case, and over 75 for China, Vietnam, and Thailand, among others. Now, the combined result of my second and third points is that societies across Asia are aging rapidly. You think of Asia as a young place, but actually, if you look at the demographic profile of the region, it's aging and aging rapidly. By 2050, there'll be over 500 million people over the age of 65 across the region. And in some countries, that change is taking place very quickly, or will take place very quickly in the relatively near future. And the point about demographics is it's inexorable. This is a trend that will crystallize. We refer to that process, the shift from high fertility and high mortality to low fertility and low mortality, as demographic transition. And whilst that phenomena is well understood in countries such as Japan and Singapore, less attention has been given to the fact that, for example, between 2015 and 2030, the over 65 population will increase by 236% in Indonesia and almost 300% in Vietnam. For comparison, during the same period, it will increase in the Western markets of the UK, EU, and the US by around 50%. Now, the aggregate economic effects of this shift are still not properly understood, but they're unlikely to be positive from the perspective of economic growth in the medium term. As Richard Jackson, who's director of the Global Aging Institute, has put it, when fertility first falls, it opens up a window of opportunity for economic and social development known as the demographic dividend. According to some estimates, the dramatic shift in East and Southeast Asia's age structure accounts for between 1/3 and 2/5 of its living standard growth since the 70s. As the demographic transition unfolds, the growth in the number of elderly eventually overtakes the decline in the number of children, and demographics begin to lean against economic growth. Well, Singapore and Thailand are already reaching that point. Malaysia and Vietnam will reach it within the next 2 decades. But at the same time as economic growth slows, an older and wealthier population is also very likely to result in rapidly increased health spending and an increased burden on health infrastructure. And Japan's experience is obviously the most salutary for us all in that respect. Demonstrates the hugely expensive process of adjusting from the end of active life to the end of actual life. The prevalence of diabetes is yet another example across the region. On current trends, it's forecast to grow even more quickly in Southeast Asia than in Europe or the US, doubling between now and 2030. The fourth macro trend that relates to population, which I want to draw attention to, is that the expansion of the total population has been accompanied by a fundamental change in its geographic distribution. Post-war economic expansion has been fueled by the typical trend towards manufacturing-based urban centres with a drift away from country to town. Cities, as a consequence, has swelled. UN projects by 2050, 2 out of every 3 people will live in an urban centre. Such a trend has profound consequences for the way in which Asian societies have traditionally provided social welfare by the extended family. But families now are often physically unable to live together and provide for each other as they have in the past. And while to some extent that's been replaced by streams of money being remitted back from workers in cities to rural areas, that's only a partial replacement. And research which the Prudential sponsored just a few years ago found that whilst the family unit is still seen as the primary care unit and as having a primary responsibility for looking after people in retirement, these attitudes are changing and changing fast. So people, societies are getting older and wealthier. And as people grow wealthier, they've more to protect. But whilst rates of life insurance and private pension are rising across Asia, they're still way behind the levels in Europe and the US. In Africa, they're hardly rising at all. It's true that Asian saving rates are high, but as I pointed out, almost 2/3 of private financial assets are held in cash. And why is that? Because 42% of spending on healthcare comes out of cash, compared to around 12 or 9% in the US and the UK respectively. Now, currently, ASEAN countries, if you exclude Singapore and Malaysia, have less than 15% of their GDP in pension and insurance assets. In China, 360 million people, that's 25% of the population, will be over 65 by 2050. But fewer than 5 million people have any kind of private pension provision. And the situation is no better if you examine state provision for long-term pensions. In only 2 out of the 10 ASEAN countries does state pension coverage extend to more than half the workforce. That's in Malaysia and in Singapore. In the Philippines, it's 26%. Thailand, 23%. Vietnam, 21%. Indonesia, 11%. Only actually in Singapore are average asset-to-income ratios among mid-life adults nearing retirement above 2.2 to 1. At the same time, the long-term fiscal position of countries across the world is far from strong. 10 years after the financial crisis, many are struggling with a combination of high levels of public debt, lower trend growth rates, and weak tax bases. The idea that the state will be able to step in and assume the increased burden of ageing and ageing-related healthcare costs looks at the least problematic. And we can add to this, in developed markets, a growing debate about intergenerational fairness, i.e. questions about whether it's fair to expect younger taxpayers facing a more challenging job and housing market than previous generations to have to shoulder the burden of increasing ageing and ageing-related healthcare costs via a pay-as-you-go system. Finally, the third gap that I want to cover, the infrastructure gap. And here again, at the macro level, the scale of the challenge is pretty clear. If we look at the need for new infrastructure, new or enhanced, improved, updated infrastructure, that's roads, rail, ports, airports, power, digital, all of which is needed to keep up with the increase in population, wealth and trade over the next decade, and compare that with the rate at which projects are being commissioned and funded, the estimated shortfall is $3.7 trillion per year between now and 2025. Half of that shortfall is in Asia, but the similar gap, similar profile across the developed world. So to summarise the gaps before I go on to the role in which insurance companies, pension fund, can play in this regard. A dramatic increase in population growth since the Second World War, driven an equally dramatic rise in GDP, and the emergence of a prosperous middle class who increasingly have wealth and health that they want to protect. The boom in the economy has led to a collapse of fertility, and populations across the board are ageing rapidly and certainly outstripping the provision of services, whether by the state or from the private sector. The geographic redistribution of population has added further pressure on the traditional methods of providing social welfare, particularly in Asia. Here, you've got high savings rates, but private financial wealth held predominantly in cash, and a very significant proportion held to cover out-of-pocket healthcare. And so the prospect of unaffordable healthcare, an unfunded old age, is increasingly near and a very present danger, and time is running out for policymakers to take action to address them. At the same time, there are concerns about whether modern capitalism is reliably generating the long-term investment which is needed to secure a prosperous future, of which infrastructure is a particularly acute example. Those then are the macro trends which shape the world facing the Prudential. And whilst I've concentrated my remarks on Asia, there are striking similarities with developed markets in which we operate, in particular the challenge for providing retirement and healthcare needs for the so-called baby boomers in the US and the UK. I want to focus a little bit now, though, upon how the insurance sector can help address those challenges. And when I use the expression life insurance, I also cover cover pension funds as well. Structural long-term savings is basically what I'm talking about here. And it's worth taking a moment before you get into the detail of what can help by looking and reminding ourselves of the fundamental nature of insurance. The basic economic and social service it provides is to enable people to protect themselves against risk and the costs resulting from risks, which would be otherwise individually unaffordable or unbearable, by pooling those risks across a large number of policyholders. And then the law of large numbers allows insurers, through the aggregation of a large number of uncorrelated idiosyncratic risks, to reduce the overall level of portfolio risk. And as well as providing a direct safety net, there are additional powerful and positive societal externalities of insurance because of the incentives that the pricing mechanism provides for good behaviour and good outcomes. So one shouldn't just focus on the direct way in which we provide and care for people's needs, but we should also take into account the externalities of the change of behaviour that arises from having insurance in the first place. It provides people an immediate financial incentive to better manage their own risks and society more generally. And all of that applies par excellence to the provision of life and health insurance to the emerging middle class in developing Asia. And that's been a major part of my own company's strategy for the last decade, and looks set to continue to do so in the years ahead. The vast majority of our new customers in a country like Indonesia, for instance, have never had life or health protection before. Buying a policy gives them and their family protection against falling out of that middle class in the event of sickness, morbidity or death, which obviously helps them individually, but also by reducing the need for precautionary savings, helps that emerging middle class to play its role in consumption and generating sustainable growth. Research done by Oxford Analytica on Indonesia, for example, concluded that for every $1 spent on life insurance premium can bring between $2.5 and $3 incremental GDP growth due to the jobs created, increased spending from consumer peace of mind, and other positive knock-on effects. And as these societies in Asia confront the ageing challenge, insurance has the potential to protect them against the increasing risk, increasing both individually and in aggregate, of running out of money in later life. Insurers have traditionally pooled that kind of risk too across a large number of policyholders, enabling them to invest in a wider range of asset classes whilst protecting them against day-to-day market fluctuations, and giving them guarantees of a certain level of income for as long as they live. That's supplementing whatever guaranteed income is available from the state. Now, those guarantees don't come cheap, particularly as longevity increases. And in the UK, there's been a lot of focus in recent years upon whether annuities are, quote, good value, or the fairness of the pricing there. But that question about fairness to customers is obviously an important one. But there's a marked contrast between countries facing questions largely of optimization and those facing challenges of savings and providing base options for how to manage those savings. Like China, for instance, which I noted earlier, will have 360 million people over the age of 65 by 2050. Fewer than 5 million are currently enrolled in a private pension scheme. Addressing that retirement gap requires a coherent set of policy responses, including changes to the retirement age and policies to allow and encourage people to work longer, extend public pension provision, and provide education and incentivization to increase private savings rates. It's too early to say exactly how different countries in Asia will respond to the challenge, but what is clear, as they look to strengthen the social safety net and explore the trade-offs between coverage, generosity of coverage, and affordability, is that the role of individual long-term savings or pensions, the wrapper is frankly less important than the actuality, is likely to become increasingly important. I want to turn now to the other side of what insurers do, what we do. We've talked about the liability side of our balance sheet, talk about the asset side of our balance sheet, which sometimes gets much less attention, and that's what do we do with people's premiums and savings. Right at the start of my talk this evening, I noted how much of private financial wealth in Asia is held in cash, around 2/3. And just now I noted that one of the functions of insurers is to provide their customers with access to a wider range of investments. That's important for them as it gives them the chance of higher returns, but it's also crucial to the economies in which they live and work. Going back to the core nature of insurance is to generate a pool of savings alongside a set of long-term liabilities, long-term promises to people, often very long-term promises, decades of promises into the future. What we need is somewhere to put those savings, and that brings us back to the third gap I outlined earlier, the infrastructure gap. Infrastructure, alongside government, long-dated government and corporate paper, is exactly the kind of long-term inflation-linked asset that insurers naturally want to invest in to match their long-term liabilities. And from an economy's perspective, such assets are better held in the insurance sector rather than the banking sector for three principal reasons. First, by definition, banks' roles, the role of banks in maturity transformation means that they are purposefully not seeking to match assets and liability by duration. By contrast, given the illiquid nature of our liabilities, an insurer or pension fund needs to duration match. In this way, we're able to avoid the liquidity risk faced by banks even when holding the same illiquid asset. In other words, the risk of an insurance company holding the same illiquid asset is not the same as the risk that presents to banks holding that same asset. Secondly, we're naturally buy and hold investors. Being able to execute a buy and hold strategy during times of market stress allows insurance companies to act as counter-cyclical buffers. And thirdly, insurers tend to want to invest in local currency and domestic assets because our liabilities are commitments to domestic savers. And because of that, as well as because we're buy and hold, our investments are stickier during a crisis. And so it's another way in which we provide counter-cyclical behaviour in a crisis. So from a micro and a macro prudential perspective, it's safer for financial stability purposes for insurers to hold such assets. And sometimes we hold those assets directly, and in the UK we have tens of billions of such assets in the UK that we hold directly. But in others, it often makes sense for us to work with multilateral development banks and other international financial institutions to create co-financing instruments, so-called blended finance, to manage political risk. And Prudential was a very early partner for the World Bank IFC in one recent initiative, the Managed Co-Lending Portfolio Program, where we committed to invest up to 500 million on infrastructure projects in emerging markets through our Asian asset management arm, Spring Investments. And if through harnessing investment from insurers and other institutional investors we can start to fill the infrastructure gap, one very important spillover effect would be in providing some of the jobs needed for the growing working age population that I've been talking about. Studies in the US suggest that every $1 billion invested in infrastructure results in between 13,000 and 22,000 new jobs, and in emerging markets that's likely to be much more. Many jobs can be created whilst simultaneously greening the economy, and I think that it's quite interesting to look at the rapid growth in the renewable energy sector in China. Now, infrastructure is only one aspect of long-term investment. We've also, insurance companies, pension funds, are also vital to deepening domestic capital markets by providing structural demand for long-term government debt, and that obviously gives price points to enable a longer-term corporate debt market to develop. And in certain countries we've also been very instrumental in helping actually structure government debt programs. In particular, I would highlight Vietnam. All of those are crucial. All of those roles of deepening domestic capital markets play a particularly important role in the development of the financial sector of emerging economies, particularly where they've been very heavily bank intermediated. First part of my talk, what are the problems? Lots of problems. Second, what can we do to address, at least in part, some of those problems? Third, what could stop us? What could frustrate or diminish the contribution that insurers or pension funds, for that matter, from making the positive contribution? Well, for insurers like Prudential to help citizens and governments and societies to address these gaps requires government, the public sector, in the broadest sense, to act in a coherent way. It requires governments and regulators to think about the development of social safety nets in concert, and of private insurance and savings and pension markets as a coherent whole. Often we find one part of government urging us to use new methods to grow insurance coverage, using digital channels, for example, while other parts, including some regulators, can seem to be focused only on the risks. Similarly, we find one part of government urging us to invest more in infrastructure, while some regulatory frameworks penalise such investments. So after years of dialogue, the European Commission and the Bank of England have acknowledged that this is a flaw in the so-called Solvency II framework which governs insurance regulation in the EU. Elsewhere in the world, for instance in Thailand, you can only invest, the way in which you can access infrastructure as an asset class is through lending. There's a rule that says insurance companies can only do insurance business. If lending is categorised as banking business, therefore insurance companies can't take part. So it's not simply a European or a Western market problem, it's also a problem in emerging markets. It goes much more widely, and I think the FSB is producing a report to the G20 summit at the end of this month, I think, on the effect of regulation on infrastructure investment across the world, and we look forward to reading that. Finally, there's a broader question, I think, of how fundamentally the advent of new technology will challenge the insurance model. Big data, and in particular the confluence of AI, artificial intelligence, and genomic intelligence, together with broader shifts in social attitudes away from collective approaches towards individualistic ways of thinking, are leading to pressure towards increasingly personalised policies. Now, for many customers, that might seem like a very positive change, indeed a long overdue change. But it also pushes the overall market, I think, or has the potential to push the overall market in two directions. Either we could face a problem of adverse selection, for example, if the risks or costs of insurance are too high, or conversely, the risk, as it were, of living too long are too high. Now, such groups could either become uninsurable or choose not to insure. Thus, the underlying risk pool upon which insurance, as I said right at the very beginning, we pool a large number of uncorrelated risks. The risk pool itself risks being undermined. There's also the possibility, I think, though, of, and this is a very unexplored space, but of public policy pushing back towards potentially more compulsion. Although I'm personally sceptical about whether the genie could actually be put back into that bottle once out, and it certainly remains an unanswered question. Now, those questions are questions with potentially very profound implications, not just for us as insurance companies, but also the societies in which we operate and which we serve. I don't have time to talk about them here on this occasion anyway, but perhaps I think it would be interesting to explore it further with this audience during the Q&A session. So in conclusion, the powerful macro trends I described earlier and the gaps that are opening up, the protection gap, the retirement gap, the infrastructure gap, are enough to keep us all awake at night. They can look intractable in developed markets like the UK, US and Europe, but many emerging economies are going to hit them at the same time and move through them at an even faster pace than Western markets. Put starkly, states can't afford to get old and sick before they get rich and insured. As a provider of life and health insurance and long-term savings, helping people to manage the risks of life's big events and channel their savings into productive long-term investment, Prudential and businesses like us, as well as pension funds, can be part of the solution. We can also help, I believe, drive a cycle of economic growth without risking and indeed enhancing financial stability. By protecting the present, we can help finance the future, funding the growing and the greying populations across the globe. But to do so, we need a coherent and supportive framework of public policy and regulation. And the best way of achieving that is to improve the quality of public and expert debate. And that's why I'm very happy to be here this evening and to give you an overview of these issues from the perspective of a practitioner in the financial sector. And I very much look forward to the Q&A. And with that, Charles, I'll hand it over to you.
Okay, thank you very much. That was very interesting.